Cedi gains ground as World Bank hails Ghana's fiscal discipline and debt progress, and also Treasury bill auction records 35% under subscription as yields decline, and GUTA urges traders to cut old stock prices to ease consumer burden. Now let's settle for the details of the story. To our first story, the government's latest Treasury bill auction has fallen short of target, recording a 35% undersubscription as investor demand eased. Out of a target of 4.24 billion Ghana cedis, the Treasury accepted 2.73 billion Ghana cedis from total bid worth 3 billion Ghana cedis. This marks a weaker performance compared to the August 8 auction, when 6.68 billion Ghana cedis was raised. Analysts say the shortfall is due to investors shifting funds into more attractive alternatives such as fixed deposit and repos. And breaking down the result, 2.02 billion Ghana cedis of the 91-day bill was accepted, along with 537 million Ghana cedis of the 108-day and 167 million Ghana cedis of the 364-day bill. Meanwhile, yield continued to decline, with the 91-day slipping to 10.13%, the 182-day to 12.23%, and the 364-day to 13.08%. And government has set its sight on raising 6.42 billion Ghana cedis in the next auction to refinance maturing debt and manage liquidity pressures. Away from that, the Ghana cedi has continued to strengthen on the exchange market this year, buoyed by tighter fiscal controls and progress in debt restructuring. According to the World Bank's 9th Ghana Economic Update, the rebound reflects improved macroeconomic fundamentals and renewed investor confidence. Inflation, which remained above 20% for March of 2024, has now dropped steadily, reaching 12.1% in July 2025, the lowest since October 2021. The report credits the turnaround to spending restraint and the enforcement of new fiscal rules in the first half of the year, alongside debt relief measures. Ghana completed its Eurobond exchange in late 2024 and signed an MOU with official creditors in January 2025. A bilateral debt relief deal with France in July further strengthening the process, while negotiations with commercial creditors continue. The external sector has also provided momentum, with stronger gold export, remittances and rising foreign investment lifting the current account into surplus and boosting reserves. Despite the gains, the bank cautions that growth will moderate to 3.9% in 2025 as fiscal consolidation takes hold, before recovering to 5% by 2028. Sustaining this progress, it warns, will require stronger revenue mobilization, tighter spending controls and urgent reforms in struggling state-owned enterprises such as Cocoa Board and ECG. Now moving on, the Ghana Union of Traders Association GUTA is calling on traders to slash prices on old stock to unlock capital and bring relief to consumers. The appeal follows the expiration of a 60-day grace period introduced in May after the cedi's appreciation, during which traders were expected to adjust prices. GUTA's Public Relations Officer Joseph Paddy explained that price stability has now lasted more than 8 months, far beyond the typical 3 to 4 month business cycle, and warned that keeping old goods at inflated prices could push traders out of business. He cautioned that traders risk losing market share if they hold on to old prices while competitors adjust to reflect new import cost. The cedi is currently trading at about 10 Ghana cedis, 40 pesos to the dollar, but despite the stronger currency, many goods have not seen price reductions because older stock was bought at higher exchange rate. GUTA President Dr. Joseph Bin has urged government to sustain the cedi stability, assuring that traders will continue adjusting prices as fresh stock enters the market. And out of our story for the bulletin, the economy may have expanded over the past decade, but job creation has lagged far behind, raising red flags about the country's ability to absorb its growing workforce, the World Bank has cautioned in its latest Ghana Economic Update. Between 2012 and 2023, Ghana's working age population expanded by 2.7 million, yet net employment rose by just 250,000. The bank described this gap as a serious threat to the nation's development trajectory and its chances of harnessing a demographic dividend. The report, addressing labour market challenges and opportunities in Ghana's economic landscape, noted that most of the jobs created over the period were concentrated in low productivity sectors, while manufacturing and higher value services recorded limited gains. This trend, it said, has left many Ghanaians trapped in low quality work with little opportunity for upward mobility. Average earnings have declined and underemployment remains high in both rural and urban areas. The bank further pointed to a mismatch between education and labour market needs, as well as persistent gender and youth disparities. Many young people, it found, struggle to transition from school to work, while women continue to face barriers to accessing quality jobs. To address the challenge, the World Bank urged policymakers to adopt an integrated strategy centered on human capital development, private sector-led growth, and business-friendly reforms. It recommended investing in education quality, aligning training with labour market needs, and promoting sectors with high growth potential such as manufacturing, agro-processing, and digital services. Kwabena Jan Kwache, World Bank economist and lead author of the report, stressed the urgency of the reform, saying that job creation hinges on unlocking private investment in sectors with potential for skill and productivity gains. The report also highlighted agriculture as a sector with significant potential, calling for value chain development and climate-smart practices to improve productivity. At the same time, it advocated for stronger social protection systems to shield vulnerable groups during economic transformation. With the working age population projected to expand further in the coming years, the bank warned that failure to accelerate job creation could result in rising unemployment, widening inequality, and mounting social pressures.